All right, go ahead and get started here. How's it going, everybody? Back with another Trade Zing webinar with yours truly, Wes Gottesman. Hope you guys are all doing well. Last time we touched on retirement accounts. So just briefly talked about the implications of Roth IRAs versus traditional IRAs and why it's good to consider a 401k. Remember, 401k is not an investment. Don't let anyone tell you do not contribute to a 401k when you can be contributing to real estate. Okay, I've heard that so many times. They're not the same thing. Okay, so if you have the opportunity to contribute to a 401k, do it. If you have the opportunity to contribute to a Roth IRA or traditional IRA, do it. Absolutely. So today we're going to talk about what happens if you are a business owner or somebody who is self-employed. Maybe they're a hairdresser or tattoo artist, whatever it is that they do. Options for them, as well as smaller employers like 100 or few employees. And if you are those employees, kind of what your options are if you have these type of plans. So one of them is called a SEP IRA, and that stands for a Simplified Employee Pension. And it was created by Congress to meet the retirement savings needs of self-employed individuals, like I just mentioned, and small business employers. So this one allows for a very high contribution amount because of the fact that you can be self-employed. You might be making a lot more money. So in 2023, 66,000. Because in 2019 it was 58, and then they increased it to 62, and now it's at 66,000. So the only thing with a SEP is that the employer is the only person allowed to make a contribution. You as an employee cannot make a contribution into your SEP IRA. The employer makes the contribution into their own SEP and then also to the employee's SEP IRA. And it can be sponsored by any kind of employer, including a corporation, sole proprietor, partnership, kind of like I was mentioning before. You could be self-employed or have a small business. And so this type of retirement account allows for the maximum amount of flexibility for the employer, meaning that the employer can decide on a year-by-year basis whether or not to contribute to their employees' SEP IRA. And they can also decide on how much they want to contribute. They don't have to contribute at all. So, if they had a really good year, they couldn't. It's completely up to the employer. That's one thing that employers find attractive about a SEP IRA. So they can contribute as much as they want or as little as they want. They have a complete flexibility, and also they can invest it however they'd like as well. So that's with the SEP IRA. Now, oppositely, there's the Simple IRA, and the Simple IRA stands for a Savings Incentive Match Plan for employees. Okay, and this is also for small business owners, usually 100 employees or less. So this provides for a salary reduction contribution. And so this one, eligible employees can contribute a maximum of $15,500 in 2023 annually, or 100% of compensation, whichever is less. If you're making less than $15,500 a year, I would consider more streams of income or a different job. So that's one major difference between the SEP IRA and the Simple IRA. One difference that is perhaps the most important difference is that the Simple IRA is actually set up through the IRS. So what happens is you'll have simple plan documents. The simple plan will actually have its own tax ID number. So let's say, so here's the simple IRA, right? So it's its own entity, it's got its own tax ID number, and underneath it is all the individual IRA accounts for all the individual employees. So this plan requires a mandatory contribution by the employer. Okay, the SEP IRA was optional. This one is mandatory, which is either a match of dollar for dollar up to 3% of compensation, or a non-elective amount of 2% of eligible employees. Whether the employee participates or not, it's up to them. So the employer cannot make any additional contributions and cannot sponsor any other retirement plan when they already have a simple plan in place. Those are pretty much the two biggest options when it comes to small business owners. Like we talked about in the last webinar, a large business owner is going to have something like a 401k. Something I also forgot to mention in the last one that also has to do with 401k is if you work for a company, you have your online 401k access, and you can go on and see how much you're in your 401k, this and that. You might also see profit sharing or ESOP, which is employee stock option plan. And so profit sharing is completely up to the employer. They can decide based on the profitability of the company if they want to make a gift contribution into the employee's profit sharing. And that amount can vary from year to year, but it's always a nice added bonus, and it's invested. With employee stock options, you get stock in the so if it's a publicly traded company, you get stock in the company, as well if it's privately held. So you also get stock in the company. You have the opportunity to exercise those when you want to. I would recommend not doing that. Don't exercise them until you are in wanting to or able to take on a tax liability, because you will have to pay taxes on those. So when considering if you're a business owner, or if you're a business owner, if you're self-employed, I mean, you really only have one option. You got to go with the SEP IRA. If you have a small business and you want to have full control yourself, you can also go to SEP IRA. For somebody who's got 100 or fewer employees, you want your employees to be able to contribute as well, you go with the simple. And those are really the main options. And then going into retirement, when planning for retirement, you're setting up these types of accounts, it's important to consult a professional, if you feel so inclined to, about how much in retirement that they think that you'll need. So for example, something that I do for my clients, that I'll take a look at their SEP IRAs and their simple IRAs, their 401ks, their Roths, their traditional IRAs, their traditional brokerage accounts, their advisory accounts, trusts, life insurance policies, and they'll come to me and they'll say, "Hey, Wes, I want to retire by this age. Based on what's in my various retirement accounts, what my incomes are, what my expenses are, how much am I going to be able to retire with? What do I need to retire with?" That's where we come in. And based on that, based on their ability, what their ability is to take on risk and how risky their investments are, along with what they currently have, how much they're spending, how much they're making, if they want to purchase an additional house, if they want to be able to send their grandchildren to college one day, what does that all look like for them in their overall financial plan? And we take that into consideration, as well as the end of their plan, which is a really nice way of putting when they die. Usually for women, we put it like 93, for men, 90 years old. Just It's how it is apparently that women outlive men. Yes, we'll see. But when working with a financial professional, you should be able to see how much money it is that you're going to have to retire with, and if you are not able to meet the amount that you think that you're going to need, as well as the amount that I think you'll need, we're going to make some adjustments in the meantime. We might say, hey, we're going to need you to start based on the amount of return that you're getting in your simple IRA or your SEP IRA or your 401k, whatever. You need to start maxing those out every year for this amount of years. Okay. And by that time, your account will grow by this much. At this point, it seems like you're going to be downsizing a little bit. Your expenses are going to be a little less. This is going to put you in a great position. If you're somebody who's younger, maybe in their 30s, late 30s, 40s, starting to plan for retirement, usually how we structure it is that we will take their assets and say, hey, right now we need to grow it to a certain point. Let's say, just for a practical amount, I'm not saying this is not any example in particular. This doesn't mean it's going to work for you, just as a disclosure. Let's just say you're going to be comfortably retired with $5 million, okay? And you'd be surprised how quickly $5 million runs out, okay? So, but currently they're only at, let's say, $3 million, but we need to grow $2 million in the next, however many years until they want to retire. So we'll go and say, hey, okay, start maxing out the 401k, start maxing this, and that. We're going to switch up your investments to growth oriented, right? So over the next 10, 15, almost 20 years until you're ready to retire, we're going to be 100% in growth stocks, blue chip stocks that are, strong fundamentals, strong balance sheets, strong leadership, stocks that you probably may have heard of, right? So we're going to be in the growth phase for the next 15 to 20 years. And then after 15, 20 years, when we start to get closer to your retirement age, we're going to switch those investments up and we're going to go into a little bit more conservative fixed income. You're retired, you're not going to be working anymore. We need to start relying off of your retirement accounts that you've worked so long and hard to build up over the years, as well as off of your current investments that we have here with us. We're going to need to switch those into income producing investments. And that way, on $5 million, you can get a return of anywhere from 4 to 5% tax free. If he's doing municipal bonds, maybe 5.5 to 6.5, maybe even 7% if he's doing some, he or she is doing dividend paying stocks. Maybe it's a mixture of both. So being able to live off of the investment income while keeping your principal invested is excellent. That's what we're looking to strive to do. Okay. And all the while, you're going to be able to start taking distributions from these various IRAs at age 59 and a half. 59 and a half, we talked about that with the IRAs and the traditional IRA and the Roth, as well as the 401k. It's the same for these. You can't take money out until you're 59 and a half. You're required to take money out at age 73. And if you don't take money out at 73, you're going to get hit with a 6% penalty. Forgot to mention that last time. They will penalize you for not taking money out of the accounts. Because you know what? The IRS, they need to get paid at some point. And they're saying, hey, 73, it's time to start taking your required minimum distributions. If you're not going to start selling out, like I said before, there's tax implications when you take a distribution out of certain types of accounts. If you're not going to start selling, we're going to start taxing you. So you don't taxing, I meant penalizing you with a fee, right? Or a penalty fee. So that's also an incentive for people to start taking money out. And it doesn't mean that you have to use it. We have clients that take money out of their IRAs and put it into their investment account and just invest it. If you don't need it, you don't have to take it as income. You can take it and you still have to pay tax on it, but then you can just put it into a different account. and continue it to grow up. So I hope this was helpful in kind of determining what type of plan would be best for you if you are a business owner or self-employed. If you have any questions, feel free to give me a call. Actually, don't call me. I say that on my, anytime I'm picking up the phone, feel free to give me a call. You guys can reach out to me at TradeZing or on Instagram at the Wes Gottesman. So hope to hear from you soon. I hope you have a wonderful rest of the week. And look forward to seeing you next time. We're going to have a great conversation.